Good evening and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending November 1st, 2024. Yep, we are into November. I am host of InvestTalk, Justin Klein. Appreciate you all for tuning in, liking, and subscribing to this channel. And this week I am titling the video Election Volatility Spooks Markets. And we'll dig into this data here. This is it's been obviously in the midst of earnings season. We have the election coming up on Tuesday, and the market has been mostly red. You can see that here. This is the last week. Only Google really bucked the trend. Google and Amazon are the two that bucked the trend of the Mag 7. You had Tesla down, Microsoft down, Apple and Nvidia, as well as Meta down, Oracle down as well, and a lot of red coming out of the banking sector and various parts of the market, especially consumer non-durables. You're talking about the consumer staples sector. Obviously, they are interest rate sensitive. Same with utilities here, right? The biggest one down of nearly 7% on the week. So it was certainly a red week for markets, and a lot of it had to do with higher interest rates. Now, let's get over to the economic data, and we'll show you why partly why interest rates continue to move higher. Now, this is the jobs openings that did decelerate once again, the JOLTS number, and we are now at the lowest level since March of 2021. Actually, got to go all the way back to January of 2021. Yeah, so that's where we're at now, and the job market does continue to weaken, but not really at a dramatic pace, which I'll show you here in a minute. Median pay year over year decelerated once again. This is from the ADP. Okay, this is the ADP number that came out on Wednesday, and that was at 4.6, the lowest level once again in nearly 4 years. Okay. Pending home sales that did tick up into positive territory for only the first time since the final month of 2023 of last year. So, 2 of the last 12 months have been positive year over year, and obviously that is a good sign for the housing industry that we've kind of hit at least a bottom. Not high level of sales, but no longer dropping. Total vehicle sales, that is chopping kind of sideways. That is kind of status quo there. You have the PCE, this is the PCE numbers. This is actually what the Fed focuses on the most. If you want to know what the Fed thinks where inflation is and where it is compared to target, look at the PCE, not the CPI, the US PCE price index, not even the core, straight up PCE 2.1%. That's basically at target. Okay, so understand that. You had initial jobless claims that did tick down once again for the second month in a row. Pretty big drop here. Sorry, second week in a row. Pretty big drop. The continuous claims that kind of bucked the trend last week, where it was like, okay, all the amount of people filing for unemployment is dipping down dramatically, but the continuous claims are at a cycle high. That didn't make sense. Well, you had a bit of a correction here over the last week. So of note, and showing that the job market, not great, but not terrible either. And the employment rate on Friday, that did go sideways, 4.1%. Now, the non-farm payrolls number came in very low at 12,000. There were some downward revisions. You actually had a negative number. The problem is this includes the hurricane season, and that's kind of colored the numbers. And so you'll probably get a big bounce back number for the month of November and December. But all the other figures are showing the job market's just fine. Like, look at average hourly earnings month over month. That did tick up for this month after dropping last month, and it just shows you that if really there were a bunch of layoffs, then average hourly earnings would not be ticking higher. Okay, so the job market's kind of hanging in there, and once again, the PCE is right about 2%, which gives the Fed room to cut, and that's what the market is expecting here. 82% chance we're going to get 2 more cuts by year end. And then by the end of next year, you're getting roughly around 350 basis points on the Fed funds rate, which would put you at about 2 cuts this year and about 3 to 4 next year. Okay, 3 to 4 next year. Now, if you look at the 2-year Treasury, which the Fed funds does tend to follow the 10-year Treasury, it's now up to over 4%, which something is amiss here, right? Because if this is going to be true, if this is going to be true, that we are going to get to around 3.5% on the Fed funds rate, then the 2 years should be somewhere around that rate as well, which we were back in September, but we've ticked higher. Now, is this a debt issue? Is this just pricing in a Trump presidency and stronger economic growth going into next year? One of these two things I think is wrong, and it's just a matter of what. If I were to bet, I do think that the 2 year probably will come back in a bit more post-election, because I think there's still room for the Fed to cut rates. So that's where the economic data is. You look at the bank credit, though, that continues to power higher. So what that means is there's more money creation, there's more liquidity in the system, and the rate on the Fed funds rate is interesting, but it's kind of a sideshow to a lot of what else is going on in the financial system, mainly a lot of government spending. The Treasury is going to issue a lot of bills in the first quarter, which will help finance the deficit without pulling liquidity out of the system. You have banks lending, government, like I said, government spending. All of that is net positive for liquidity. So it's hard to see a major drop in equities in that environment between now and call it the end of the first quarter. And these are the data points that I'm looking at to say, okay, is the recent volatility in markets, does it really hold any water? Is there any reason for this to have a major drop here? So let's pull this up. Let's look at let's go to the cash SPX here. And what you see is, you had a decent drop on the week. If I zoom out to a weekly, you had you had a down week followed by last week's down week, 2 weeks in a row negative. Pretty good volume this week as well. But once again, there's a lot of jockeying in position for the election. Now, one of the reasons I think this is coming off is because the odds of a Trump presidency were really high earlier in the week and late last week. But it started to kind of converge back down to closer to a 50-50 race in the odds markets by the end of the week. And it's kind of what I've said. I said I still think maybe Trump has a slight lead, but not as dramatic as the odds makers, the odds markets were saying. It's still roughly a 50-50 contest, and it's hard to know how the House and Senate are going to end up. There's just so much up in the air in these politically volatile times, and so I think that's part of it here. You're seeing once again a correction now, the 15 moving average. Usually that's good support. We got a bounce on Friday after hitting that, but it kind of faded throughout the day. So that kind of tells me that I don't think that this is the low here. We have basically 2 more trading days until the election, right? We have Monday, but then we won't know much even at the close on Tuesday. Won't know much until probably Wednesday morning. And but look at the NYSE, that's closed at the lowest levels since mid-September. So I do think there's probably some more downside in the short term. And if you look at like the VIX, for example, that continues to kind of edge higher. I was talking about how this is a bullish consolidation, and we are likely to get some sort of breakout in volatility around the election, and that's what you're seeing here. But how much of this is real versus just fear around an election outcome that is more uncertain? I think there's still a very high likelihood that we know pretty well who won the election by Wednesday morning, and the markets will start to price that in and make adjustments. But I don't think it's going to create a major market volatility event. Let's just say that. Okay. The move index, that is moving higher as well. Now, you'd think the Treasury refunding announcement for the first quarter kind of should quell a lot of this. And maybe this is why they're talking about issuing a lot more bills versus notes in the first quarter, is because they're seeing the move index move higher. Because this is the volatility of the Treasury market. So when this is going up, it's saying, hey, the government can't fund itself. That's basically what it's saying, that there's too much volatility within the Treasury market, and this is a problem. So I think that Treasury refunding announcement is paying attention to this move index, and I'll be continuing to watch that to see if this continues to take off above 50, and that could be a problem. That could throw a wrench into markets, or does this kind of settle back down, below 110, and I think that would be more bullish for markets. So we'll see kind of what that looks like. Um, let's take a look at credit. So that's another reason why I think everything is fine. The credit markets, kind of holding in here, short-term junk, and this has come down a little bit, but nothing really wrong there. The growth versus value trade, I do think you are seeing. I think there will be a rollover next year in growth stocks, and you're kind of seeing it in this pattern. This is a big move down in July and into August, and then this is a bear flag here, which I think will resolve to the downside, mainly because these cyclical stocks are, I think, will inflect higher, and then the higher interest rates, which I think generally will be the case, will bring down multiples in lots of parts of the market. And I think the AI trade is just a little bit long in the tooth, and you can see that with a lot of these. There we go. There's the SMH. This is looking bearish, right? This is another kind of one of those bear flags here. Nvidia is really the bastion of strength here. You have SMCI, which was one of the super micro, one of the AI trades that has just they had counting issues and just falling out of bed. Now maybe it's near a bottom, but ultimately this is not a good sign. And even when you look at some of the bigger names like an ASML, those are struggling as well. And so you're getting a lot of weakness out of the semiconductor space, which tends to lead the overall tech sector as a whole. Same with biotechs. Biotechs are seeing weakness here. You see that nice little bounce on Friday. But if you look at the Nasdaq, look at this compared to the Nasdaq. Nasdaq pulled back a little bit, but obviously is a bit stronger. And so biotechs and semiconductors, with their relative weakness, is telling me a lot about, I think, the future of where the tech trade is headed. What else do I want to get to? Let's get to gold, right? Gold had a bit of a pullback as well with markets. And, ultimately, I think it needed it. It's a bit overbought, right? Look at this long move, but I don't think that's going to be the death knell of gold. I just think it's ready for a bit of a breather here. So it would not shock me to see gold as well as silver, right? Silver also had a bit of a breather. Silver is always more volatile and something to continue to watch out for. But don't think that I don't think this is the end of the precious metal trade. I just think it's time for a little breather. Utilities that did kind of fall out of bed here once again over the past couple of weeks, and this is all because of higher interest rates. Right here, the 10-year bonds. So you're seeing that move on the IEF from 99 to 93. Same with the TLT, right? Even longer term bonds. And that's a big drop from nearly 102 all the way down to 90. So you're seeing that volatility. You see that big? Look at the big volume on the 30-year of the TLT on Friday. Now, does that mean that's a bottom? I think potentially, but I still think rates are going to be range bound overall. So don't get too excited one way or the other. See if there's anything else I wanted to get to. I think that's about it. It's a good overview there as we head into Tuesday. We also have Fed week. It's election week, but it's also Fed week, and that will be important to markets as well. So expect a lot of volatility. Overall, I think we'll settle out within 2 to 3% of where we closed on Friday by the end of next week. I don't think it's going to be a big 5%. 10% move in one direction. The downside support is around 5,400 on the S&P. Is that possible? Yeah, I think that's the extreme, but that's still only about 3 or 4% from here. So don't think this is a market that is going to break out, because I think we're overbought, but I also don't think it's going to break down, because I think generally economic growth remains relatively solid, as well as the credit markets remain relatively sound. And unless those two things change, I think the general uptrend of equities will stay in place for at least a short to medium term. Okay. Thank you all for tuning in, and Reminder that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.